Hi friends, welcome to JD's guidance once again. Friends, today we are going to talk about a new topic, that is rules of debit and credit. Friends, this is a very important topic in accounting because your knowledge about or your concept about debit and credit can help you learn accounting smoothly. So please try to understand this concept clearly from this video. So let's start. So debit and credit are the underlying rules that govern the recording in accounting. So let's see. So you can see these rules of debit and credit can be learned in two different ways. One is the traditional approach, another is the modern approach. So we have two different approach basically. In books they call it in different names. So the idea is that there are two ways to learn the rules of debit and credit. Let's see the traditional approach, okay? In the traditional approach, we have got three different accounts. We have real account, personal account and nominal account. To make it simpler, let me just give you a clue or a hint about these accounts. Real account refers to the physical assets like furniture, like buildings, okay, like machine. These are all real accounts. These are all classified in real accounts. Whereas personal account are the people. For example, the Mr. X, Mr. Z, from whoever you have transacted, okay, with whom you have made some transaction, that will come under personal account. Coming to nominal account refers to all types of incomes and expenses, okay. If you have earned something or if you have paid something, that will come under nominal. So real is the physical things, assets, liabilities. Personal are the people and nominal are the expenditure and income. Now let's see what is the rule. So the rule of real account says that debit, so as you know, debit has to be written as dr. Debit is written as dr. What debit what comes in, credit what goes out. That means from your business, if something is coming in, then you have to debit it, but if some things are going out, then you have to credit it. For example, you are buying a furniture, so what is coming in the business? What is coming in? Furniture is coming in, so you have to debit the furniture. But for buying the furniture, what is going out? Cash, the money is going out, so credit what goes out. So I repeat, in the real account, if some real account is coming, real assets or any kind of assets coming in, so you have to debit it. If it is going out, then you have to credit it. Coming to personal account, debit the receiver, whoever is the receiver, suppose, and credit the giver, So suppose you have sold goods to Mohan, so who is the receiver? Mohan is the receiver, so we will debit Mohan account debit. But if Mohan has received cash, so Mohan account will be credited, okay. So any person who receives will be debited, any person who pays will be credited, okay. Coming to the next rule, that is nominal account, debit all expenses and losses, credit all incomes and gains. So if you have made some expenses, for example, salary is paid, so payment of salary is an expenses, so you will debit the salary. If you have received interest, receiving of interest is an income for you, so you will credit it. So friends, this is about the traditional approach, and please try to understand. In traditional approach, we have debit the receiver, credit the giver. Debit what comes in, credit what goes out. Debit all expenses and losses, and credit all incomes and gains. So this you have to remember thoroughly, right? So friends, let's give an example again. Suppose I'm starting from this one, nominal account, salary is paid, so payment, it is a payment, so salary has to be debited. Interest received, Interest received is an income, so it has to be credited. So interest will be credited. Coming to personal. Sold goods to Mohan. So you see who is the receiver? Mohan, right? Received cash from Mr. Jack. So made payment to Mr. Jack. Sorry, received payment from Mr. Jack. Since Mr. Jack is giving us, so Mr. Jack will be credited. Okay. Coming to real account. In real account, debit what comes in? If machine is been bought or purchased, machine is coming in, so machine account debit. And credit whatever goes out from the business. So if you buy something, cash is going out, so cash will be credited. So this is the traditional approach. Now coming to the modern approach. In modern approach, we have got assets, liabilities, income, expenses and capital. I repeat, A stands for assets, A stands for assets, L stands for liability, A stands for asset, L stands for liability, I stands for income, E stands for expenses and C stands for capital. So we have these things in the business. We have in the business assets, liabilities, income, expenses and capital. Let's understand what are assets. Or assets are anything that a business owns. Whatever the business is owning, that is your assets. For example, if I have building in my business, it's an asset. If I have machines in my business, it is a asset. If I have cash balance, bank balance, that is my asset. Liabilities are the obligations of the business, anything that the business has to make payment in time to come. So these are liabilities. For example, there is some bills outstanding, so it's a liability. You are to clear some creditors, that's your liability. Okay, creditors are people who sell to you on credit, so it's not your asset, it's your liability. Okay, coming to income. So as I already gave you many examples of income, interest received, commission received. Okay, these are all your incomes. Expenses, salaries paid, rent paid, wages paid, these are all expenses. And capital, anything that is required to start and continue a business is known as capital. Okay, with capital we start the business. Now what's the rule? Rule is that I will tell you that if there is an increase in asset, you have to debit. If there is a decrease in asset, you have to credit. And asset has got a debit balance. Okay, so asset always has debit balance. What is this debit balance? You will understand later, but for time being, that means the closing side of, when you have the closing balance of an asset, it will always be having a debit balance. Okay, let's not go into it. Let's just today understand what are the rules. So debit means if there is an increase in asset, you will debit. If there is a decrease in asset, you will credit. Liabilities is just the opposite. It has got credit balance. So if there is an increase, it will be credited. If there is a decrease, it will be debited. So it is just the opposite of this one. Increase debit here, increase credit here. Decrease credit here, decrease will be debited here. Okay, decrease will be debited here. Coming to incomes. Okay, so you have income, credit balance. If there is a increase in income, you will be crediting it. If there is a decrease in income, you will be debiting it. Coming to expenses. Expenses have debit balance. So if there is an increase, you will debit it. If there is a decrease, you will credit it. Okay, coming to capital. Capital has credit balance just like liabilities. Okay, so if there is an increase, you will credit it. If there is a decrease, you will debit it. So please take a note of these rules. Increase in asset will be debited, decrease in asset will be credited. Increase in liability will be credited, decrease in liability will be debited. Increase in income will be credited, decrease in income will be debited. Increase in expenses will be debited, decrease in expenses will be credited. Capital increase is credited, capital decrease is debited. So friends, today is just knowing the rules of debit and credit. We will use these rules and we will try to solve problems in the next class. Thank you for watching this video, and there are 2 questions at the end. Please take note of them. Bye bye.